For 2 years, the Cybercab has been Tesla's most talked about and least detailed product. Today, that changed. A U.S. Environmental Protection Agency filing, made public this morning, gave us the first real production numbers on the car Tesla is betting its robotaxi business on. And almost at the same time, drone footage caught more than 100 of them lined up at Giga Texas, ready to ship. We've also got 4 straight months of clean federal safety data on Tesla's robotaxis. A Reuters investigation into the safety figures Tesla showed European regulators. A new self-driving update that's drawing pushback. And a pair of Wall Street strategists pointing at the same risk. This is the Tesla Brief after the close on June 15th. Welcome to the show. A quick look at the stock. Tesla closed up 1.2% at $411. But the broader market did far better. The Nasdaq jumped 3.1%, and the S&P 500 rose 1.7%. So Tesla actually lagged a big up day. The rally wasn't about Tesla at all. The US and Iran reached an interim peace framework, oil fell, bond yields dropped, and risk-on names led the way. Tesla rose with the tide, but trailed it. Nothing company-specific was pushing the stock harder than the overall market was moving. Let's start with the Cybercab. The EPA quietly issued what's called a Certificate of Conformity for the Cybercab, the document that certifies a vehicle as clean enough to be legally sold in the United States. It was signed in late May and only made public this morning. On its own, that's a procedural step. But buried in it are the first hard numbers Tesla has ever shared on the production version of this car, and they tell you exactly what kind of vehicle Tesla has been building. Here's what the filing shows. The Cybercab is a 2-seater. It's front-wheel drive with a single motor making about 219 horsepower. It weighs roughly 3,100 pounds, about 400 pounds lighter than a Model 3, which makes it the lightest car Tesla has ever built. And it carries a small battery, around 48 kilowatt hours, less than half of what sits under a Model Y. That small battery is the whole story. In the EPA's lab tests, the Cybercab managed over 400 miles of range, though the real-world sticker number will land closer to 270 to 300 miles once it's adjusted. More striking is the efficiency, 165 watt-hours per mile, which the filing makes the most efficient electric vehicle ever certified in the U.S. More efficient than cars that cost 3 or 4 times as much. Now here's why a smaller battery is a feature, not a compromise. The Cybercab was designed from the ground up for one job: short trips around a city as a robotaxi. A personal car needs a big battery because you might drive 300 miles in a day and want to charge only once. A robotaxi doing 5-mile hops around Austin never needs that range. So Tesla put in a much smaller battery. And that does 3 useful things at once. It's cheaper, which is why Tesla is targeting a build cost under $30,000. It charges faster, so the car spends less time plugged in and more time earning. And it's lighter, which stretches every mile further. Tesla pitches the running cost at 20 to 40 cents a mile, a fraction of what a ride with a human driver costs. The EPA green light matters because it clears one of the regulatory steps standing between this car and paying customers. And it doesn't arrive alone. Drone footage from Giga Texas yesterday showed 102 Cybercabs staged in the factory's outbound lot, the most anyone has counted, with 55 more already spotted in Dallas. So Tesla isn't just building these cars, it's shipping them to robotaxi cities and stacking up inventory. That's what a company does right before it turns something on. That certification answers what the car is, not when it goes live. 2 questions are still hanging. First, the version on the road today still has no steering wheel and no pedals. And that configuration needs a separate federal safety sign-off that the EPA filing doesn't cover. Second, and more important, the gating item by Tesla's own account isn't the hardware anymore. It's the next big rewrite of the self-driving software. Until that lands and proves itself, 100 parked Cybercabs are 100 parked Cybercabs. So the thing to watch isn't the next production photo. It's the moment those staged cars start carrying paying riders with nobody in the front seat. And that brings us neatly to the safety question, because 3 separate signals on Tesla's self-driving collided today, and they pull in different directions. It's worth slowing down on all 3, because together they say something about where Tesla is and isn't being careful. Start with the good news, and it's genuinely good. The Federal Road Safety Regulator, NHTSA, publishes a monthly report on every incident involving Tesla's robotaxi service. The latest one shows a single new event. Back in April, a Tesla robotaxi was sitting stopped and got rear-ended by a truck. In other words, Tesla wasn't at fault. Add that to the 2 incidents in March, also a stationary robotaxi, also hit by a human driver, and you get 4 straight months with 0 at-fault incidents from Tesla's driverless fleet. Every single incident in the data is a human hitting a parked Tesla. Why does that carry weight? Because this isn't Tesla's own marketing. It's the federal regulator's own database. And clean regulator-grade safety numbers are exactly the missing ingredient for 2 things bears keep flagging: how you price insurance on a scaled robotaxi fleet, and how Tesla wins approval to operate beyond Texas. So this is a real quiet positive. Now the awkward part, reported by Reuters the same day. Reuters obtained correspondence through public records requests in Sweden and the Netherlands, showing Tesla presented its own self-published safety figures to those governments, while lobbying for European approval of full self-driving. The headline number Tesla showed regulators that FSD could have saved 32,000 lives. The problem is how that number was built. It assumes every single vehicle in the United States, including freight trucks and motorcycles, gets replaced by a full self-driving Tesla. Independent researchers told Reuters the assumption is absurd and the figure falls apart under any scrutiny. Here's why that stings. Tesla has genuinely strong safety data it could show. The clean NHTSA robotaxi record we just walked through is real, and it comes from the regulator, not from Tesla. Instead, the documents European officials were handed are the stretched, marketing-grade ones. Getting caught showing inflated numbers is the kind of thing that slows an approval timeline all on its own, separate from how good the technology actually is. And Europe is one of the harder pillars in any bull case for self-driving revenue, a large market Tesla has been promising to enter for years. This is a self-inflicted wound at an awkward moment. And the third signal, over the weekend Tesla pushed a self-driving update that adds a game-like layer. Drivers now get a little confetti celebration when they hit a streak. 250, 500, 1,000, or 5,000 consecutive miles without taking over from the system. The streak survives a lane change or a gentle nudge on the accelerator, and resets if you brake hard or grab the wheel. The pushback was immediate. One of the most widely followed independent self-driving testers said publicly he doesn't like a reward system that pushes a supervising driver not to take over when they should. Several owners made the same point. If you're chasing a streak, you might tolerate a mistake you'd otherwise correct. And that also quietly skews the safety data Tesla collects from the fleet. Put the 3 together and a pattern shows up. Tesla tends to talk about its supervised consumer self-driving and its unsupervised robotaxi as one single software story. But the safety rules and the incentives around them are pulling apart. The driverless fleet has a clean federal record. The consumer side just got a feature that arguably rewards less supervision, and a credibility ding in Europe over the numbers Tesla showed officials. All of it can be true at once, and a careful owner holds all 3 in view rather than picking the one that flatters the story. Let's move to Wall Street, because 2 strategists went on the same network this morning and from different angles pointed at the same risk for the kind of stock Tesla is. The first is Savita Subramanian, head of U.S. equity strategy at Bank of America. She's not outright bearish, but she laid out 4 headwinds stacking up against the big tech trade Tesla rides inside. The good news, she argues, is largely priced in. How expensive these stocks are relative to their earnings has already started coming down. The big tech companies have slowed their own buybacks, which removes a buyer. And the backdrop is tightening. The year began expecting interest rate cuts, and so far has gotten none. Her sharpest point is about expectations. She thinks earnings growth is genuinely strong. She's modeling 22%. But returns from here, she argues, depend on companies beating expectations, and analysts are now forecasting, in her words, close to the highest long-term growth rates in earnings that we've seen in the history of our data. When everyone already expects greatness, there's not much room left to surprise to the upside. The catalysts that powered the last few years, the ChatGPT moment, the recovery from COVID, government and central bank stimulus, aren't coming back unless there's a sequel. On the same network, Dan Niles of Niles Investment Management framed it differently, but landed near the same place. His view is that the market's strength is rotating, in his words, back toward where AI money is being spent, not the companies spending it. That favors the chip makers, and it's harder on richly valued names like SpaceX, trading at something like 45 times its sales. And here's the part that matters for Tesla. Niles pointed to Tesla's roughly $11 billion deal with Google and its $15 billion deal with Anthropic. Call it $26 billion of revenue Tesla is now picking up from that flow of AI spending. He framed that as evidence Tesla is increasingly on the receiving end of that money, not just laying it out. So what we can take away from this cuts both ways. The AI narrative tailwind that's been doing a lot of the work on how expensive Tesla stock is has less room ahead than behind it. That's Subramanian's caution. But Niles' angle is a reminder that Tesla is now actually selling into the AI build-out, not just buying chips for it. Two strategists, same morning, same setup, pointing at the same pressure from opposite ends. A couple of operational items to round things out. Tesla handed over its first Model Y L, the longer 6-seat version, to a customer in India today, at its Mumbai showroom. It starts around $66,000 there, because India's import duties effectively double the price. And that's why Tesla has sold just 350 cars in the entire country since launch. So this is a foothold, not yet a volume market. More interesting strategically, Tesla filed permits in Florida for its first pre-assembled megachargers, the high-power chargers that feed the Tesla Semi. It's the same trick Tesla has used to speed up its supercharger rollout. Build most of the unit at a factory, ship a nearly finished piece, and drop it into place. Each one weighs about 9,600 pounds, and Tesla has more than 60 megacharger sites planned. It won't move the stock today, but taking time and cost out of building that charging network is a real lever for the Semi business as it scales next year. Which brings us to the one thing on the calendar worth flagging before we go. Today's whole rally ran on that US-Iran peace framework. Oil down, yields down, the broad market up. But the real test comes Wednesday, when the Federal Reserve meets, the first meeting with Kevin Warsh as chair. Consensus is for no change in rates. What matters more is the projection that comes with it, which sets the tone for the rate path through the rest of the year. That's worth caring about as a Tesla owner. Because for a stock like this one, how expensive it is relative to earnings does a lot of the work, and that's tied closely to where rates are heading. It's also the exact pressure point Subramanian raised this morning, that the market started the year expecting cuts and has gotten none. So the question heading into Wednesday is simple. Does the Fed's rate path back up that cautious view or take some pressure off it? That's the next real signal. That's the Tesla Brief for today. If it's been useful, please subscribe. Thanks for joining us, and we'll see you in the next episode.